Hey guys, AKIL'S here. Welcome back to the Trading Coach Podcast. Today, we're going to talk about the most important trading metric that I look for when evaluating data. So in this episode, we're going to cover topics such as building a portfolio, the importance of having and using a position sizing strategy, how to compare equity curves, and some game-changing advice / lessons, I guess, that I learned while I was managing money. Now, this is a video episode of the Trading Coach Podcast, which means this, right? If you want to see kind of the graphs and charts and the little things that I'm creating and moving around, make sure you check it out on a podcasting app where you can watch the video like Spotify, or head over to YouTube. And if you are a regular YouTube subscriber and you're like, what is this type of video? This is the Trading Coach Podcast, which the usual audio versions are only available on podcasting apps. So the video versions are like the little crossover. Anyway, let's hop in. When you combine different currency pairs, backtest individually into a single sheet, what is for you personally important in terms of collective results? Good question. My equity curve. So the smoothness of my equity curve. So obviously, I want to make as much money as possible. Return on investment is good. Like I want my return on investment, my ROI, right? My bottom line, my profit, whatever you want to classify it as, I want that to be as high as possible, right? Because I like making money, right? Process over outcome, yeah. We do it to make money. Let's not forget that. However, I also understand the power of position sizing. I also understand the power of having or using, I personally use a money management or position sizing strategy, money manager / position sizing strategy. And in order to stay on track with that position sizing strategy, I know I need to limit my drawdowns. So in the equity curve, when you combine all of it, I am looking for the biggest and greatest return on investment as possible, but I am not willing to sacrifice large drawdowns for that, right? So for example, I can have a return, I'll give you two equity curves, right? And I'll tell you which one I would pick, right? I can have equity curve 1 that looks like this. Right? Or I can have equity curve 2B, I'll change the color. That looks like this. Now, equity curve B is much lower than equity curve 1, right? I need to get these letters correctly. Equity curve A in white, which I will color white at some point. No, darn it, Akil. All right, you guys get what I'm saying. The top one is A, right? The top one in white is A. The lower one is B, right? And again, we're just, plugging in numbers, whatever like that. I would prefer an equity curve that looks like B than A, right? A is the one that has a much more jagged line to it. It goes up really, really high. 20% returns, but then 18% drawdown. Where B is slow and steady, right? The highs aren't as high, but the drawdowns aren't as low. And the reason why B is more important, the smoother one is more important than A, is one, if I'm following and using a position sizing strategy and money management strategy, then I know that as my account size increases, as my profit increases, I can increase my position size. As I increase my position size, I can make more money. So I want to be going in a steady upward direction, because that's getting closer and closer to my goal of increasing my position size, which will ultimately make me more money. With the choppy equity curve, even though it has a higher return on investment, there's much more risk, right? There's much more risk involved. And I remember going back to when I was doing money management for clients. And when I first got into it, I was young, right? So I had no idea what wealthy people actually valued. What I did was I finagled, right? I used a money management approach that would create the greatest return on investment, right? So I had my stats. I implemented a money management strategy. I had different versions of it, but the initial one I would present them with was the one that had the biggest return on investment. So I'd go to them and be like, look, I can make you a 200% return on investment every year, like thinking it was going to wow them, right? And guess what? Nobody cared. None of the real investors that the people that really had money, none of them cared. They were like, what's your drawdown? Like, what does it cost me to get that 200%? And I'd go through it and I'd be like, well, there was like a 50% drawdown here. They're like, no. I'm like, okay, but it returned 200%. They're like, yeah, son, but I would never put half my account at risk, ever. That's not smart. Do you guys think that's smart? Would you ever be comfortable with a 50% drawdown? I'm going to make you 200%, but the risk is that at some point you may lose half your money. No, yeah, because if that happens twice, you're done. You lose all your money, right? So the key is conservation of capital, especially with wealthy individuals. It's not about making as much as you can. It's about preserving as much as you can while making as much as you can after the fact, right? So you want to protect your capital at first. Then it's like, once I'm protected, how much can I make on top of that? And you do that by different ways, like diversification, not just like throwing a bunch of more money in there. So when you're looking at your collective stats, right? And this is the interesting thing. You may have, let's say you tested 10 pairs. You may have tested 10 pairs and, you may have 5 pairs, 1, 2, 3, 4, 5 pairs that were awesome. You may have 3 pairs that were like, you're kind of okay. You don't really do much, right? And then maybe you have 2 pairs that suck, right? So obviously we want to get rid of the 2 pairs that suck. You guys would probably agree with that. Like if they suck, they don't return anything good, like get rid of them, right? What we would initially think is like, okay, let's just like use all the 5 pairs that were great and that will make us the most money. But that's not the case, right? Because some of those pairs may have volatile returns. Let's say your greatest performing pair, if that's one that made a lot of money, but also had some really bad losing streaks, you're going to have an equity curve that looks more like the choppy one, more like A. Because although it has these really hot streaks, it also goes cold for quite a bit. But you may not necessarily want to sacrifice that because you're like, Akil, like it made me a lot of money. And, so what you do is you balance that out. When you build your portfolio, you say, you know what, I'm going to take this great returning pair that is, it's a little bit moody. It has swings. I have this other pair over here that it's okay. It doesn't really make me a lot of money. It's not bad. Like it's an average pair, right? But it also doesn't really lose me a lot, right? And when you combine those together, what do you think happens? Well, now you get kind of the best of both worlds. You have your large returns, but you also have a steady Freddy pair, as I call them, that keeps your head above water while this large returning pair is going through that drawdown. Right? You guys follow me on that? I'm trying to think of an analogy that is, I can't really think of one, but usually I'm good with analogies. I'm thinking of like Flintstone cars. We have a bunch of people, like really strong people moving the cars with their feet and weak people in the middle. But yeah, you're looking for diversification. So you're not just looking for the greatest returners. You're looking for how can I combine these to get the best results, right? So my portfolio, for example, I told you this before. I don't know if you guys have ever tested it, right? Dollar Canada sucks with patterns. Dollar Canada is not a good pattern pair at all. And people ask, well, why is it in my trading portfolio? Well, it's a very good pair for other reasons. So when Dollar Canada is being stinky, right? My other pairs, which are good with advanced pattern formations, right? They're chugging along. In fact, advanced pattern formations in general are the steady Freddies for me. They just kind of slowly do what they do. They don't really go through hot streaks or cold streaks like my other trading. They're just kind of steady. So it balances everything out. But the fact is, let's say when patterns are on that cold streak, Dollar Canada is making up for it with the directional stuff. So everything is put together to kind of find the best fit. It's very similar to like building a sports team. This is a good analogy, right? Of course I would go back to sports, right? If you had an all-star team of just all great players, right? You guys familiar with Cristiano Ronaldo? Probably, right? Second most handsome guy in the world after yours truly. Right? So if you had 11 Cristiano Ronaldos on a team, would that team be good? Hell no, right? Because he's not going to play defense. He's not a good goalie. He wouldn't pass to none of them would pass to each other. It would be a bad team. You're like, Akil, well, how can you have the greatest player in the planet, arguably, or maybe second greatest, and not have a good team? PSG would have been another good example. Oh man, I'll do that next for you guys that are familiar. But you need a balanced team. So PSG, right? Paris Saint-Germain, right? Good example. They had Neymar, Messi, and Mbappe on the same team, right? So arguably 3 of the 4 greatest players in the world, like 3 of the top 5 greatest players in the world at the same time. Their team that they have now that they got rid of them, is better. Now, how is it better? They had those 3 great players, but they couldn't really work with each other. They all did the same thing. They all had the same flaws. They all needed the ball. They all wanted to score. None of them wanted to play defense. So although like they were probably the most intimidating team when they had most intimidating team when they had the ball, meaning that defenses were scared because all 3 of them can score and create, they weren't going to help you at all on defense. So teams would just run right through them and score back. Now they have a more balanced team, and they're playing much better because now they have a specific person that is good at scoring, a specific person that is good at passing. They have specific people that are good at defense. It's the unit as a whole works a lot better. So that's what our portfolio should be. It's the unit of a whole. And sometimes it means like ditching a really high returning pair. Sometimes it means involving a pair that is not that great, right? You may have a player where it's like, why is he starting? Well, he's starting because he does something that no one else does, the dirty stuff. And you need a dirty player on your team at some point, right? So that's the fun part for me with like building a portfolio and looking at them together. I'm looking for return on investment. I like the money, don't get me wrong, but I'm also looking for the smoothness in that equity curve. Because that is key from a financial perspective. You want to avoid those drawdowns. Because keep in mind that your real life drawdowns are going to be worse than your backtesting drawdowns. Your backtesting drawdowns are simply because of your system or strategy. Your real life drawdown is also because of psychology. You're going to make mental mistakes. It just happens. And when you make those mental mistakes, you are more likely to make more mental mistakes. So it does work from a financial and a psychological reason. When you can stay kind of on a steady incline of being good and keep your drawdown small, you're more likely to stay mentally stable. When you're more mentally stable, you're more likely to do the things that you're supposed to do. But yeah, combining them and finding that perfect fit of like, hey, 2 steady Freddies with maybe 4 volatile ones, or vice versa, 3 and 3, or even if it's like, you know, different strategies, advanced patterns, trend continuation, counter trend, right? Diversification, however you look at it, is key. And in my opinion, you want to keep that Kaizen philosophy, that slow, steady incline from left to right versus that violent bounce from up and down. Now, 2 things before you leave. 1, if you're watching this on YouTube or just heading over there at some point today, make sure you subscribe to my channel. I post a lot of content. I also want to reach the goal of 60,000 subscribers, so I need your help to do it by subscribing and sharing this with your social community. Also, if I do things correctly, I plan on following up on this conversation in the next Trading Coach podcast. And I plan on digging a little bit deeper into the business side, I guess creating a business approach to building your trading business. Yeah, I haven't figured it all out yet, but I think I'm going to do that. So stay tuned for the next episode. Until then, plan your trade, trade your plan. Take care.